Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I want to talk about uranium. I was going through Twitter, reading some things with some opinions here. I'll read it here and I'll give you my opinion kind of backing it. This is Derek, and I know he's pretty big on uranium. And I like to get different viewpoints from different people. It says, we are likely here in a uranium bull run, as I posted this in September 2020, both charts. Far from stupid. New paradigm. We have the media phase coming with inflation, supply down with Sputnik, demand going up. Will be fun coming back here when we break 100 plus. And this is what he's got for some charts. And the charts here, this is a kind of the phases that, there's 4 phases: a stealth phase, awareness phase, mania phase, and a blow-off phase that a stock or a sector will go through. And he's got here 2020 kind of being somewhere in this. He thinks that we're at where this arrow's at right here. And obviously it's probably correlating very close to this. It says bubble or uranium, uranium or bubble. Notice how similar they are. End of 2020 into 2021 is going to be the media attention phase. Longer bull market is what he has on here. We're at 3165. This was posted 2021. Adjusted for inflation, 2373. The one thing I want to show you guys, and one thing I want everybody to kind of understand here is I've got the data here of new privately owned housing unit starts, total units. And I'm going to pop it right in real quick. What drives these things is liquidity, inflation, and the rotation of money. That has a huge impact on the pricing of commodities. And I know we're looking at supply demand. I know we've got a lot of people that always talk supply demand, supply demand, supply demand. No one talks about the inflation aspect. The inflation aspect is more important than supply demand because your supply demand comes from the inflation aspect. Hopefully that makes sense. I'll say that again. The inflation aspect is more important than the supply and demand of a commodity, unless it is something that is way out of whack in terms of supply demand, like a palladium or rhodium was in 2016, 2017, 2018, and going forward. The inflation will rotate money. It'll move large sums of money. I'm talking massive amounts of money, because all of that money went into stocks and bonds. That money is going to rotate and go into commodities and precious metals at some point. We're speculating on when that point is. In history, that point has usually been, if you look at this upper left, where these guys go into an expansion phase of real estate, because the expansion phase of real estate is an inflationary cycle. We've gotten kicked off, this cycle's gotten kicked off, I would say, a little bit early because of money printing from C19. So the cycle's kind of already started a little bit because of that inflation coming from the money printing from C19. But this is what's going to sustain it. And they may sustain high levels of inflation, money printing, and I won't go into it, but high levels of money printing after C19. And there may be deeper things behind it on the end of a debt cycle, which is just going to amplify the move. Now, if you look kind of how these things played out, uranium was peaking a little bit before the peak of other commodities. It peaked in 2007. But the cycle ran very close. And if you look at it, I'll come back here. The cycle here started at about 2001. And then it slowly gained and really started to take off. And the deficits back here weren't that large in terms of the supply-demand deficits. The supply-demand deficits are much larger coming up in this next, I would say, decade plus. Now, I'm gonna switch back to here. This decade plus, we're gonna get support from the new housing starts for that entire period. That is what usually drove inflation in the past. We do have this further, we'll call it ingredient, where they threw in a bunch more inflation on top of the mix from C19. But we also have very low commodity prices that are just starting to turn up. We've got a CRB to S&P 500 that's just starting to go into and turning up into an uptrend from a downtrend. So downtrend, sideways to uptrend. and everything is intact, and I won't go over these two. Well, I'll go over this one. The gold to monetary base is incredibly low. And last cycle, we went from 2000 to 2007 when gold turned up, and I'd say uranium and gold are highly correlated in terms of when they turn up, the timing of it. Doesn't mean they're correlated at all by what they do in terms of a lump of metal and another metal that is used for energy. But what potentially can happen here, and I don't think people are fully realizing this, and this goes across all the commodities. If that gold, if right there, that gold to monetary base ratio, if this comes and gets accounted for, if this comes back up, what is happening is you're getting a massive rotation of money. It's rotating out of stocks and bonds into precious metals and commodities. Uranium has no room or no size to absorb that amount of money. So price has to go way higher for it to absorb it. I think we are way earlier in this than what most people think. I don't think it's going to be a 1 year, 2 year, 3 year thing. I think this is going to be like a decade-long massive boom under an inflationary period. And if you looked in history here, this boom in the 1970s, the first hit, then gold kind of came back, and then it hit again, correlates very well with the housing starts and what it did. So this was demographics driven, and we've got a large demographic coming up behind it, which is larger than where we are today for a good, I would say at least 5, 6, 7, 8 years, and we're underbuilt in housing by 5.5 million homes. So that underbuilt scenario, with the demographic, with all of the money that could potentially rotate from higher interest rates, and I think our interest rates are what's going to put the pressure on the rotation, I think we're far earlier than what most people think, and the moves are going to be far bigger than what anyone thinks. Because they haven't lived through that rotation. They haven't lived from money rotating from stocks and bonds into something else. And this has been 40 years in a declining interest rate environment. You're going to see something that we haven't seen for over 40 years. It'll be like 50 years ago. Hardly anyone was alive and working right now at that point. So the way they're positioning companies, the way that they're positioning things, I think is going to be kind of eye-opening and mind-blowing when this money starts to move around differently than what they've seen in the past. Because in a declining interest rate environment for 40 years on, it's been the same. Now, if we hit with high inflation, which is coming, and we see it, it's already here. If we can maintain that high inflation rate, all this money is going to rotate. It's going to be a huge rotation. And when that money rotates, uranium, I don't think is going to stop at $100 a pound. It's not going to stop at $200 a pound. It's going to go to areas much higher than that, because what you guys are taking is you're looking at the nominal dollar value. I'm looking at an inflation adjusted value. So the value may be $800 a pound, but inflation adjusted, maybe it's $200 of yesterday's dollar, so to speak. So what I'm saying is the inflation aspect, that component is bigger, and it's not being accounted for by most people. And usually what runs first is oil, and then it spreads its way through everything. So I was reading that, and I'm like, man, and the way that he has, the potential of where we're at, I think this is more like down here. I don't even think we've seen the bear trap yet. Potentially. But we'll see. And maybe these things are much larger, but I think we're very early in this game. There's no way that we are at a 2006 point in the last bull market. We're like at, I would say we're more at like 98, 99. We're probably over here. We're not up here. We can move this guy down here. And I just want to make sure everyone understands that, because what people are doing is they're taking the old paradigm of what they knew in the past and they're projecting it forward. What I'm saying is that paradigm's done. Like, throw it in the garbage. And the way that you can see that is if you were to look at, I think I have a chart here that I can yank up real quick. Let me see if I can find it here. This is what I'm talking about here from the old paradigm, is the 10-year Treasury bonds. We were in this 40-year, since 1980, 40-year decline. Well, yeah, 40-year decline. And we're just starting to break to the upside of this 10-year treasury bond. We're putting in a reverse head and shoulders, and it's about to break to the upside. This is like paradigm life-changing outlook that people haven't grasped yet. If this is coming in front of us, this big kind of inflationary period, and I don't know if it's going to last this long because the demographics have to support it, but maybe it lasts for a good 10 years or something like that, where this comes up here or tries to. And even if it tries to, even if you have the inflation get kicked up and they hold rates down, you're just going to get larger and larger real negative yields. No one's is going to want to hold bonds. No one's is going to want to hold stocks. Well, they might hold stocks, but they won't hold bonds in a real negative interest rate environment that large, in my opinion. So we are really, really early. We're not in the late stages like in 2006. We are like in the year 2000 or 1999 or 1998. Probably 98, 99, somewhere in that range. We probably bottomed in 98, and then we started coming back up in 99, and then things started to really start to heat up in 2000, 2001 for most commodities. And that's where we're at. If you look at the oil chart, I think I've got an oil chart somewhere in here. This is the longest downtrend ever broken from 1970 all the way down. It's the copper to gold ratio with copper breaking to the upside. I just wanted to touch on that. But here's oil. And if you were to look at oil, gold to oil ratio went to ludicrous levels. It's coming back down, but it's just breaking out of its big old pattern. And yeah, we had a sell-off here, but the projected move is $160 plus. And we've got the XAU to gold ratio. All of these ratios, when you look at the out of the side view mirrors and compare it to what uranium was, they're barely getting moving. They haven't even moved yet. So we are like in the 98, 99 time frame of this move. And if we were to look at that 98, 99 time frame, we're over here. We're not over here. I think we're over here. And I think that we have a massive move coming ahead of us, much larger than what most people think. So that's something I wanted to touch on. I just wanted to make sure, that's my opinion on it. I could obviously be wrong, but when you look at the other sectors, if you look at oil, natural gas, you start looking at some of these other sectors, they're just kind of breaking that first move. They're putting in their first wave of a big three-wave pattern up. That goes for copper and all these other ones. So I think we're kind of earlier than what most people think, and the big moves are still ahead of us. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.